Ladies and gentlemen, I want you to stop what you are doing and listen carefully, because what I'm about to share with you is not a new system. It is not a shortcut. It is not the latest fashionable theory making rounds in the trading clubs of New York. What I am about to share is the truth, raw, unvarnished, and earned through decades of sitting before the charts when fortunes were made and lost in a single afternoon. I am Richard Wyckoff, and in all my years of studying, trading, and teaching the markets, I distilled everything into exactly 2 indicators. Not 5, not 10, 2. If you leave this discussion today understanding nothing else, understand this: every trade you have ever lost, every false breakout that fooled you, every rally that reversed the moment you entered, happened because you ignored these 2 indicators. Or worse, you never knew how to read them at all. Stay with me. By the time we are finished, you will never look at a chart the same way again. Let me take you back to the winter of 1910. I was sitting alone, late at night, surrounded by rolls of chart paper and the remnants of a cold supper. The markets had humiliated me that week, not because I lacked information, but because I had too much of it. Moving averages, oscillators, momentum readings, ratio studies. I had layered indicator upon indicator, like a man burying himself alive, and still, nothing worked. I pushed everything aside that night. I asked myself one simple question: if I stripped away every calculation and looked only at what the market itself was telling me, what would I see? What I discovered in the hours that followed changed the entire course of my trading career. The market, I realized, is not random. It is not chaos. It is a story, and like any story, it has characters, a plot, and a direction. Most traders are reading the wrong pages. They are staring at calculations while the real narrative plays out right before their eyes. Now, before I reveal these 2 indicators, I want to ask you something. What do you believe drives the market? Think about it for a moment. Is it news, earnings reports, sentiment surveys? Here's what took me years to accept. None of those things move the market in any lasting way. They are pretexts, justifications applied after the fact. The market is moved by one force and one force alone: the battle between supply and demand. And there are 2, and only 2, instruments that allow you to see that battle as it unfolds in real time. The first is volume. The second is price. Yes, that is all. But do not mistake simplicity for weakness. In the hands of a disciplined observer, these 2 indicators reveal what no formula ever could. Let me show you exactly what I mean. Volume is the heartbeat of the market. It is the one indicator that cannot be fabricated, cannot be smoothed into false comfort, and cannot lie. When price moves, volume tells you whether to believe it. Think of it this way. Suppose a crowd gathers in the street and someone shouts that there is a fire. If 100 people turn and run, you believe there is a fire. If only 3 people shuffle nervously, you are skeptical. Volume is that crowd. It is the conviction behind every price movement. Now, here's where most traders go wrong. They watch volume as a single number. They see a large bar and assume it is meaningful. But volume must always be read in context. Context is everything. Ask yourself these questions every time you study a chart. Is volume expanding as price rises or contracting? Is volume heavier on advancing days or declining days when price pauses in a sideways range? Is volume building quietly beneath the surface? These questions, asked consistently and honestly, will reveal something extraordinary. Here's the concept that unlocked everything for me, and it will unlock everything for you. The market is not driven by thousands of random individuals making independent decisions. In every meaningful price movement, there is an orchestrating force I call the composite operator. This is the collective intelligence of the large, well-capitalized interests, the syndicates, the institutions, the operators who possess both the resources and the patience to engineer market moves over weeks and months. They are not reckless. They are methodical. And when they act, volume reveals their footprints. I will give you a concrete example. In the early 1920s, I studied the accumulation of a major railroad stock. For weeks, price drifted sideways. Boring and unremarkable, most traders ignored it entirely. But the volume told a different story. On each minor dip in price, volume surged, quietly, persistently. On each minor rally, volume thinned. What did this mean? The composite operator was absorbing every share being offered. Sellers were finding eager buyers at every turn. The supply was being systematically removed from the market. 3 months later, that stock rose 40% in 6 weeks. Volume told the story before price ever did. Now, have you ever been caught in a move that felt powerful, confident, and convincing, only to reverse the very next day and leave you wondering what went wrong? I want you to remember that feeling, because I am about to explain exactly what happened. When price moves dramatically on thin volume, you are witnessing what I call a false move. The composite operator and his associates are not participating. The move is driven by emotional traders reacting to headlines or rumor, and the operators are waiting just off stage for the crowd to overcommit before they push in the opposite direction. A surging price on poor volume is not an opportunity, it is a trap, and volume, read correctly, will warn you every single time. Now we turn to the second indicator. And here is where I must caution you against dismissing what you are about to hear as being too elementary. Price, in its raw, unadorned form, is the most honest reflection of market reality that exists. I am not speaking of price averages. I am not speaking of price oscillations or momentum readings derived from price. I am speaking of price itself, the actual number at which the last transaction occurred, the spread between the high and the low. The position of the close within that spread. Price is the market's language, and every bar on your chart is a sentence in an ongoing conversation between buyers and sellers. The key, and this is what separates the disciplined analyst from the speculating gambler, is understanding where price is within the market cycle. Let me describe the 4 phases through which every market, in every era, in every instrument, will inevitably pass. The first phase is accumulation. This is where the composite operator quietly builds his position. Price moves in a trading range. The public finds it dull and uninteresting. Meanwhile, supply is being steadily absorbed. The chart shows modest advances, tight price spreads on weakness, and a gradual series of higher lows. This is the phase where fortunes are prepared, not made. The second phase is markup. The operators, having accumulated their position, now withdraw their support on the sell side. Supply has been absorbed, demand exceeds supply, and price rises, often sharply, often dramatically. Volume confirms the move. This is the phase where fortunes are collected. The third phase is distribution. Now the operators, having profited handsomely from the markup, begin to quietly offload their holdings to an increasingly eager public. Price may continue to advance, but the advances become labored. Volume swells on down days. The chart shows wide-ranging bars closing in the lower portion of their range. The public is most bullish at precisely the moment the operators are most bearish. The fourth phase is markdown. Supply overwhelms demand. Price falls, often with devastating speed. The public, which bought enthusiastically during distribution, now sells in panic at a fraction of what they paid. Every market, every time. These 4 phases. In the autumn of 1929, many of my contemporaries were ruined. Some were brilliant men of great intelligence and considerable experience, and yet they were destroyed. They were destroyed not because they lacked information, but because they misread the phase. They saw price rising during distribution and assumed the markup was continuing. They saw volume expanding and assumed it confirmed strength, when in fact, that volume was the operators selling into their enthusiasm. The chart of the 1929 market, studied with the discipline I am describing today, told the story with absolute clarity for months before the crash. Wide price spreads, heavy volume on declining days, weakening closes, lower highs forming beneath the surface of what appeared to be a still buoyant market. Those who understood the phase, who recognized distribution for what it was, preserved their capital. Some of us profited handsomely from the decline that followed. Understanding the phase of price is not optional. It is the entire game. Now, here's the principle I want you to carry with you for the rest of your trading life. Price without volume is conjecture. Volume without price tells you nothing of direction, but together These two speak with one voice, and that voice belongs to the composite operator. When price advances and volume expands, that is genuine demand. Believe it. When price advances but volume contracts, that is a performance with a small audience. Be cautious. When price declines and volume swells dramatically, that is genuine supply or climactic panic selling. Either way, pay attention. When price declines on diminishing volume, the selling is exhausting itself. A reversal may be near. These 4 combinations. Memorize them. Apply them to every chart you study, in any market, in any era. They have not changed in 100 years, and they will not change in the next 100, because human nature, the fear, the greed, the impatience, does not change. Let me now give you the practical framework I have used and taught for decades. When you sit before a chart, ask yourself 5 questions in sequence. First, is price in a defined range or is it in a trend? This determines whether you are observing accumulation, distribution, markup, or markdown. Second, on days when price advances, is volume expanding or contracting? Expansion confirms strength. Contraction warns of weakness. Third, on days when price declines, how does volume behave? Heavy volume on declines suggests genuine selling pressure. Light volume on declines suggests the market is simply resting. Fourth, are there signs of strength? Higher lows, tight spreads on weakness, volume drying up on pullbacks, or signs of weakness? Lower highs, wide spreads on declines, volume swelling on down days? Fifth, where does this current behavior fit within the larger 4-phase cycle? That is your entire analytical framework. 5 questions. 2 indicators. Complete clarity. I want to address something directly, because I have taught many traders over the years, and I have seen this pattern repeat without exception. The trader who fails is not the trader who lacks intelligence. Intelligent men fail in the markets every day. The trader who fails is the trader who overcomplicates, who adds one more indicator, who chases one more signal, who convinces himself that the answer lies in greater complexity. A young man came to my office in the late 1920s. His charts were covered in calculations, colored lines running in every direction, each one the product of a different formula he had read about in some publication. He had been trading for 3 years. He had nothing to show for it but frustration and diminished capital. I sat him down. I handed him a clean chart showing only price bars and volume. I said, "Tell me what you see." He looked at it for a long time. Then he looked up at me and said, "I think someone has been quietly buying this stock for months." He was right, and that was the first correct market reading he had made in 3 years. The tools had not given him clarity, they had stolen it from him. There is one quality without which these 2 indicators cannot be properly used, and I must speak of it plainly: patience. The composite operator does not rush. He does not act impulsively. He builds his position over weeks and months, absorbing supply with the discipline of a professional and the patience of a man who knows precisely what he is waiting for. Most traders lose money not because they cannot read the chart, but because they cannot wait for the chart to speak clearly before they act. They enter before the volume confirms. They exit before the phase completes. They are governed by emotion, by fear of missing the move, by the discomfort of sitting in cash while others appear to be profiting. The operators count on this impatience. It is the very mechanism by which they extract money from the retail crowd. Every premature entry is a gift to them. Every panic exit is a gift to them. Your task is simple to state and difficult to execute. Wait for the chart to tell you what the operator is doing, and then trade in the same direction. Nothing more, nothing less. I anticipate the question forming in your mind. You are thinking, "But Richard, what about moving averages? What about the relative strength index? What about all the other tools that modern traders use?" Here is my answer, and I will be direct about it. Every indicator you have ever used, without exception, is a derivative of price and volume. Every one of them takes these 2 raw realities, processes them through a mathematical formula, and presents the result with a delay attached to it. By the time a moving average signals a trend, a disciplined reader of price and volume has already acted. By the time an oscillator signals overbought conditions, the operator has already begun distributing. Derivatives lag. Raw data does not. I am not telling you those tools cannot be of occasional use. I am telling you that if you do not first understand price and volume, the inputs upon which those tools are built, you are reading a translation of a translation, and something is always lost in translation. Go to the source. Always go to the source. We are near the close of today's discussion, and I want to leave you not with a summary, but with a challenge. Tonight, before you sleep, open a chart, any market, any time frame. Cover every indicator, remove every line, leave only the price bars and the volume, and then simply watch. Ask yourself, where is this market in its cycle? Is volume confirming or contradicting the price movement? What is the composite operator doing? Accumulating, distributing, marking up, or marking down? You may not see it clearly on the first attempt. That is entirely expected. Mastery does not arrive overnight. It arrives through repetition, through honest review of what the chart told you versus what actually followed, through a trading journal in which you record your observations and test them against outcomes. But I promise you this, and I make this promise having watched hundreds of traders transform their results through exactly this practice. After 30 days of sincere daily study of price and volume, you will see the market in a way that you cannot unsee. The noise will fall away. The signal will sharpen. And the composite operator's footprints, which were always there, will become unmistakable. There is no shortcut past these two indicators. There never has been, and there never will be. Volume and price are not tools I recommend. They are the truth of the market, the only honest report it ever files. Everything else, to theater, to dupper, is commentary. Master them with patience. Study them with discipline. Trade them with conviction. And remember this, above all else, the market rewards those who listen and punishes those who assume. I am Richard Wyckoff. I have given you my life's most important teaching in the time it takes to drink a cup of tea. What you do with it is entirely up to you. Study the chart, trust the volume, understand the phase. Good trading and good fortune to all of you.